Now let's talk about the cluster of income and expenses that FASB feels should not be excluded from the main income statement, and therefore requires companies to embed them within the income statement, but that analysts do frequently want to remove them from the income statement results so that they can hone in on core operating profitability. These types of items include restructuring expenses, one-time write-offs, gains and losses on sale of assets, severance costs, litigation gains and losses. These 5 sort of clusters of income and expenses tend to be the kinds of things that FASB doesn't think are unusual and infrequent, like extraordinary items or discontinued operations or accounting changes, but they're somewhat unusual. So FASB sort of identifies that if you're unusual or infrequent, but you're not both, just sort of an arbitrary sort of way to designate how non-recurring you are. And those items, FASB actually requires that companies report pre-tax within the income statement. Analysts generally don't agree. They look at things like restructuring expenses, one-time write-offs, gains and losses and sale of assets, severance costs, and they say, we want to look at this company's operations without the noise of these things because we think that these are, being unusual or infrequent, these are things that are going to skew our ability to compare this company's current results against prior period results, this company's current results against other companies' results, as well as gauge what they may do in the future, how these items may also impact our ability to forecast properly. So analysts like to exclude these from the results. Walmart not only has discontinued operations, but they also have these unusual or infrequent items. So let's take a look at what's going on in this slide. Walmart discloses in the footnotes that they had restructuring charges of $260 million. And they've also identified that they've embedded them within operating, selling, general, and administrative expenses. Restructuring charges are things that do not rise to the level in FASB's eyes of being truly non-recurring and therefore, being allowed to be represented below the income statement. They have to be lumped into these core line items. Analysts are going to want to look at those operating, selling, general, and administrative expenses as if that $260 million wasn't there. If I was an analyst looking at this, I would say restructuring charges, those probably aren't going to happen too frequently. I should look at this year, this $85.265 billion, and this year I'm going to treat it as if Walmart generated $85 billion flat, because 260 or so is due this non-recurring item. And that creates that disconnect between what analysts want to see and what GAAP requires that companies, or what FASB requires that companies present under GAAP. One other issue to keep in mind, just like with stock-based compensation and amortization expense, if you are going to pretend as an analyst like that restructuring charge didn't happen, which is basically what ignoring it is, it also means that you have to adjust taxes. When the restructuring charge that we just looked at is pre-tax and embedded within pre-tax line items, that's the case here, the pre-tax restructuring charge. If we pretend like that didn't happen and just look at operating SG&A as just 85 billion flat, then you're also going to have to pretend like the tax shield that having incremental expenses creates isn't going to be there. And that's what this slide is about. That when restructuring items or non-recurring items are presented pre-tax, eliminating these non-recurring items should be accompanied by the elimination of their tax impact. And the way to think about it is that eliminating non-recurring items is like pretending they didn't occur. And if you extend this logic, if a non-recurring expense is ignored, so should the associated tax shield.